Market volatility continued for investors in July as the Eurozone sovereign debt crisis intensified and the risk of contagion spread to the larger countries. As a result, equities, particularly European equities, fell in the first few weeks of the month. The flight to quality was most evident in the Eurozone government bond market, where investors favoured German government bonds over all others. However, it was the rise of Italian and Spanish government bond yields that raised most concern. Concerns about the sustainability of Italian debt levels prompted an aggressive sell-off in the Italian government bond market, which is the largest in Europe. Because Italy's total debt to GDP remains over 120%, the recent rise in bond yields would make this debt level unsustainable. This raised concerns that the existing European bailout policies would be insufficient to save the larger countries such as Spain and Italy. This high level of market stress prompted the Eurozone leaders to meet to find a solution to the crisis, whereby they agreed another bailout package for Greece and additional support for Ireland and Portugal. The new package was worth €109 billion to Greece, of which €37 billion will come from some form of debt swap or rollover from the private sector. Also, the rate of interest charged to Portugal and Ireland was lowered by between 1% to 2%. The EFSF fund also received new powers to help countries not already receiving bailouts, such as precautionary lines of credit and the ability to recapitalise struggling banks. The fund will also be allowed to purchase bonds in secondary markets in exceptional circumstances, once it has been approved by the ECB. Negotiations between the White House and Congress continued in the US as the deadline approached as the country faced the possibility of debt default without an agreement. Rating agencies continued to pressure politicians by threatening to downgrade the US credit rating unless an agreement could be reached. Nevertheless, US equities remained resilient despite this looming risk, while US bond yields remained largely unchanged. The political deadlock in the US about the debt ceiling dominated in the last week of the month, and despite reaching an agreement, the US was downgraded by Standard & Poor's.